Well, unfortunately, this isn't an April Fool's joke because the yield curve just inverted for the first time since 2019, sending a strong signal that the US is likely to go into a recession over the next 12 to 24 months, given that every time in the past 50 years that this has happened, the US has then gone on to go into a recession. So in today's video, I'm simply going to be breaking down what the yield curve is and how its different shapes over time can tell us about the condition of the economy. I want to talk about what it looks like right now and give my opinion about how long-term investors can navigate the fact that the yield curve has now inverted. Now more than ever, it is critical that you are accurately tracking the performance of your portfolio over time in terms of capital gains, dividends, and currency gains. Particularly currency gains, if you're buying shares from Australia in the US, there's going to be significant fluctuations, and there has been so far. So in order to make sure that you're tracking those things accurately, I highly recommend you go check out Sharesight. It's a sponsor for today's video, and they have a completely free plan that you can use and track up to 10 holdings. So if you just want to try it out, you don't have to give them a dime or a cent. I don't know why I said dime, I'm Australian, but there's a link down in the description below. It'll be the first link there where you can join for free. As I said, try out the free plan for as long as you want. Or if you use that link and want to sign up to a paid plan for more features, to track more holdings, access more performance and tax reporting, then you can get 4 months of a yearly subscription if you use my link. So go check it out if you're interested. But with that said, let's jump into the video. Before we talk about the yield curve, it's important that we have a base understanding of what a bond is first. So a bond is a fixed income security that essentially allows corporations or governments to get access to debt. So it's a way for corporations and governments to borrow money, and through the purchase of a bond, if I was to buy a bond from, say, a corporation or from the US Treasury, I'm giving money over to the government, and they are giving me a bond, basically a contract or a certificate that says that they will pay me back that principal as well as a coupon payment over time. And the combination of the price that I pay for that bond and the coupon payments that I receive is of course going to generate a yield for me, essentially a return on that investment. And when a bond is first issued by, say, the government, they issue a number of bonds in order to take on some debt, the yield will be dictated by the coupon rate attached to that bond. So if it's got a 5% coupon rate, and it's a $1,000 face value bond, you will be receiving $50 every year, and your yield will be 5%. It will be the yield that's on the bond. Now, after that, the bond could be sold on the secondary market, on the bond market. It can be traded, and in that way, the price that you pay could be higher than the actual $1,000 face value of that bond that you will get at the end of the maturity, or it could be less. And whatever you end up paying for that bond is of course going to impact your yield. And it's important to understand that the yield of the bond and the price of the bond work inversely. So if the price of a bond goes up, the more you pay for a bond, the lower the yield will be, because you're paying a higher price for the same fixed coupons that you're receiving, the same income, because remember, the income is fixed. So if the price goes up that you pay for it, the yield, the return you get goes down, and vice versa is true. If you pay a lower price for that bond, the yield will be going up. And that'll be important to understand when we're talking about the yield curve, which is a way that we can represent different types of maturing bonds on a graph. On a side note, it's really important to understand how bonds work as a foundation of stock market investing, because one of the things that Warren Buffett talks about is that the valuation of stocks is extremely similar to the valuation of bonds.
Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years.
The only difference is that on a bond, you know exactly what you are going to get back from that bond. It's written on the coupon, it's written on the bond, what the coupon payment is, whether it's $50 a year or $60 a year. The bond tells you exactly what the income will be. Whereas a stock, we don't know what it will generate in terms of cash flow or profit for us each year. We have to figure that out. But understanding how bonds function is a good way to understand how we can think about valuing stocks. So what is a yield curve? Well, a yield curve is simply a graph that compares the yields of different maturing bonds in a certain class. So you might have a yield curve for corporate bonds, or you might have a yield curve for US government bonds. When we're talking about the yield curve and the yield curve inversion, we're talking about the curve that represents US government bonds. So different maturities, whether it's a 1-year bond, a 2-year bond, a 5-year bond, a 10-year bond, a 30-year bond, and seeing how their different yields compare. And typically the graph has an upward slope. From left to right, it slopes upward, and that makes perfect sense because the shorter maturing bonds have a lower yield than the longer maturing bonds because your money is locked away for longer in those longer bonds, so you need to demand, or in most cases, you will be demanding a higher yield on your investment. And the other way to think about it is also during good economic conditions, people don't want to lock their money away for long periods of time at relatively low rates. They want to put their money to work over the long term in better performing assets when things are going well. But the yield curve does change over time depending on economic conditions and market sentiment. So while it normally is quite steep and going up to the right, it can flatten over time, which essentially means the yields on different bonds become very, very similar. There's no kind of added benefit in terms of yield for going into a longer bond. And then very rarely it will invert, which means that the yields on longer bonds is smaller than the yield on shorter term bonds. And the logic behind this is that institutional investors that are moving this yield curve for the most part with most of the money in the market, they're moving their money out of short-term bonds, US government bonds, and into longer term bonds because they see the next couple of years as being much more risky and they want to lock their money away in a decent return, or at the moment it's pretty terrible, but they want to lock in somewhat of a return for a long period of time. It's essentially an indication that institutional investors fear that a recession is coming, that the returns of assets is going to be very, very poor in the short term, and they want to lock in even a 2.5, I think it is at the moment, long-term rate on a 10 or 15-year bond. And the crazy thing about this measure is it's not just a technical indicator, it actually impacts whether the US goes into a recession. And it turns out to be somewhat of a self-fulfilling prophecy because as institutional money moves away from these short-term bonds and into longer-term bonds, you see the yields on longer-term bonds go down relative to short-term bonds, and short-term bonds seeing yields go up relative to long-term bonds. And what that means for riskier firms that rely on short-term debt, rely on accessing the bond market to get money, they're now having to pay a higher yield for that debt, and those firms will start to crumble, and that often fuels the beginning of a widespread recession. And there's actually even a better way to look at the yield curve rather than just looking at the shape of this graph over time, and that's to look at what's called the 10-to spread, which is just the difference in yield between the 10-year bond and the 2-year bond. So normally the 10-year bond will have a higher yield than the 2-year, so this graph will be positive. If it goes to 0, it essentially means the yield curve has flattened, and if it goes negative, meaning the 2-year bond has a higher yield than the 10-year bond, then essentially the curve has inverted. And historically, every single time that the 10-to spread has gone negative, the US has gone into a recession in the next 12 to 24 months. So you can see that it happened in the 70s, it happened again in the 80s, it happened again in just before 1990, it happened again just before the 2000 crash, it happened in 2006, happened in 2019 very briefly, and today it has once again gone negative. So if this measure, which has accurately predicted or preceded a recession 12 to 24 months in advance every single time for the last 50 years, if it is going to act in the same way that it's acted over that huge period of time, then the US will be heading into a recession likely sometime in the next 12 to 24 months. So that's kind of the news side of things. Let me share my opinion as well on how I think you should navigate the markets and what I'm personally doing as well. First of all, don't try to time the market. This has never been something that has worked consistently over time. Even with a measure like this, being able to seemingly predict a recession coming, people have still not been able to accurately time the market, selling their stocks and then getting back in at the bottom. And one of the key reasons why is because, first of all, we don't know when a recession will come. It's also entirely possible that a recession doesn't happen, that things don't happen as they've happened in the past. It's also entirely possible. But even if we do go into a recession, there's no guarantee that the stock market will even collapse based on it, or how deeply it will collapse, for how long, or what that will look like. If you remember, the last time the US went into recession in 2020, the stock market went up 16% that year. I know it went down significantly during that year, but the market was up during the year that it was in recession. So the stock market doesn't always kind of mimic what is exactly happening in the economy. So this indicator really shouldn't affect your investing behavior. Ultimately, if you're looking at the individual businesses, then you don't care about a particular indicator. And all this should really do is cement the importance of having really strong investing principles. And for me, that means investing in businesses that I deeply understand, so I have a good grasp on how this business is likely to perform over time. The business needs to have a distinct competitive advantage or a wide economic moat. I just did a video covering all of the key types of economic moats according to Warren Buffett, so you can check that video out if you're interested. Has to have a strong management team that's good at their job and honest. They have to be in strong financial health, and that's a critical one. If we're going into a recession, you want to know that the businesses you're investing in are strong enough in order to survive through even an extended period of weak economic activity. And then, of course, we need to figure out what those businesses are worth and only invest in them when they are significantly priced significantly less than what they're worth. As I mentioned at the start of the video, particularly with the volatility happening in the markets, and probably in all likelihood you're making different trades at the moment, whether you're buying into businesses or selling out of businesses, you want to be accurately tracking the performance of your portfolio over time. And the easiest way to do that is by using something like Sharesight, which, as I mentioned, has a free account that you can use forever. So go check it out if you're interested. I'll leave a link to it down in the description below, and you can also get 4 months off a yearly subscription, which is a great deal if you do want to sign up to a paid plan for more premium features. But that's all for today's video. I hope you guys got some value. Leave a like on the video if you did. With that said, hope you guys have a great weekend, and I'll see you in the next video.